Another block is not just a big candle, it is evidence of institutional absorption, and most traders mark the wrong ones. Today, you will learn how to identify the other blocks that institutions actually leave. Before we proceed, hit the subscribe button and give this video a thumbs up. These are the things we are going to cover in this video. What is order block? Types of order block. Why most traders get order block wrong? Rules for a valid order block. Chart examples. Valid versus invalid order block. And how to trade order block. What is an order block? Another block is an area where there has been a large concentration of orders waiting to be executed. Types of order block. One, bullish order block, and two, bearish order block. The short form of writing order block is OB. So anywhere you see OB, you know it is order block. Bullish order block is the lowest down close candle near support. Let's look at it together. Here is the down close candle, and here is a support level whose high is later traded through by subsequent candle. Let's analyze what created this order block. Markets was trading upwards. All of a sudden, price pulled back, and when price pulled back, it got to a support level, and smart money traders pushed it aggressively up and left order here that are yet to be filled. What happens is that later on, price may likely return to this zone to fill the unfilled orders here. So that is how order block is created. Traders usually place the order waiting for the price to return to this zone. So this is bullish order block. The next one is bearish order block. Bearish order block is the highest up close candle within a resistance level whose low is later traded through. Let's also look at it. This is the up close candle. The candle has been traded through and there is displacement. So this is the bearish order block. Why most traders get order blocks wrong? They mark every large candle as order block. Figure 2 is a good example of marking wrong order block, but when we get to the rules, you will understand better. Make sure you calm down and listen to this explanation so that you can easily identify valid and invalid order block. I'm taking time to explain it so that you get the full gist before we go to chart for practical session. And make sure you watch to the end. Number 2, ignoring market structure. Number 3, not waiting for displacement. And number 4, using order blocks without liquidity context. Let's look at rules for marking a valid order block. Number 1, supports and resistance. Before we mark order block, it must be at a support or resistance level. Number 2 rule is validation. Number 3 is displacement. If you are not familiar with ICT terminologies, I'm going to explain these last 2 rules so that you can understand and follow well. What do I mean by validation? Let's pick validation of bullish order block. For a bullish order block to be validated, the high of the lowest down close candle, the high of the lowest down candle, here is the down candle, and here is the high, must be traded through for this bullish condition. So price must trade through the high before you can consider this down close candle a valid order block, and it must be at the support level as we stated in our rule. Once price trades above the high of, or trades through the high of the down close candle, there is validation. That's what I mean by validation. Then for bearish condition, the low of, let's see the example here. Here is the low of the up close candle. So the low of the highest up close candle must be traded through. Here is the highest candle and the low has been traded through. Once price trades through it, it is validated. Then if you don't understand what displacement means, displacement means strong aggressive price movement. As you can see, after price violated this order block, there is displacement. Price moved away aggressively from the order block. That is exactly what I mean. Even in this point, after price violated the bullish order block, price traded away aggressively from the order block. That's what I mean by displacement. We can now go to charts, bearing in mind all the rules we have stated. There are just three rules here: support or resistance, validation, and displacement. So for bullish order block, we are looking at support level, and for bearish order block, we are looking at resistance level. So let's go to chart and identify valid and invalid order blocks. We have our full market structure doing higher high, higher low. At this point, we have the lowest down close candle, and it was violated by this. So this our rule, and there's displacement. Our rule is confirmed. This is order block. Following the same rule, this is also order block. Then for us to trade this order block, we need to wait for price to return to it and also create liquidity. So for example, this one now, price pushed away and created liquidity here. Now after creating liquidity, price traded down to the zone and moved to take out the swing high here. So this is how to trade order block. Then you mark out the next order block, wait for price to return to the zone after creating liquidity. As you can see here, price created liquidity and later on it returns to the order block and price continued higher. Here is another down candle. After break of structure, we can look for another order block. Since there is inducement here, we mark out this order block is the lowest down candle. Wait for price to retest it, like to return to the zone after taking out liquidity, and we can execute our entry here and target the next swing high and put our stop loss below this low. So that's how to trade order block. adjust price slightly below the other block candle, which is here, slightly below it, then target the next swing high. This how to trade other block. Practice this and you will get to understand. We can look at bearish example. As you can see, price is making series of lower high, lower low, and it created liquidity. And here is the last up close candle. Let's mark it out. Price came to mitigate it after taking out liquidity, or we can use our short tool here, pull this and adjust the stop loss to the high of the up close candle, slightly above it, then and target the next swing low, which is this one here. So this is exactly how to trade other block. And remember, what we are looking at is the body of the candle that we are marking. So it's the body of the candle that we are marking. In our subsequent videos, I'm going to teach the overlap of other block and fair value gap. So see you in the next video.